As we've said before, businesses do basically two things. They raise money and they allocate those funds toward business assets. This is illustrated in accounting by looking at the balance sheet. On the right-hand side of the balance sheet, you have funding sources. On the left hand, you have business investments. Figure 1.1 in the notes illustrates this. Under funding sources on the right-hand side, the firm can raise money by borrowing either through the issue of bonds or by tapping into available funds from short and long-term lenders. The business firm may also sell preferred stock to investors called preferred shareholders or issue common stock to investors called common shareholders. Another way of raising equity funding is through the retention of earnings. If the firm makes a profit and those earnings are retained in the firm, this automatically becomes additional investment for the common shareholders. On the left-hand side, business investments can include both current assets and long-term assets. Some examples of current assets are cash, marketable securities, accounts receivable, and inventory. And some examples of long-term assets or property, plant, and equipment are factories, machines, computers, buildings, facilities, or equipment. All of the sources of funding for a business come from people who have wealth. This includes creditors or bondholders. It includes preferred shareholders who buy the preferred stock that a company issues, and the common shareholders who buy the common shares that a company issues. The first source of funding is creditors. Creditors are a special type of investor who provide funds to a corporation through a contract. The contract can be a negotiated one, where the lender and the company get together to decide on the features of the contract, such as the interest rate, the term, and the payments. Another way is a standardized loan called a bond. Business firms initiate these bonds and offer them for sale in financial markets to creditors who are called bondholders. A bondholder is lending money to the corporation. The corporation must repay that plus interest. The second source of funding is from preferred equity. Firms offer preferred shareholders the right to receive income in the form of dividends if they purchase preferred stock. And the third source is common shareholders. Firms offer common shareholders an ownership interest in the company and the opportunity, not the right, but the opportunity to share in the excess earnings of the firm. The company doesn't actually have to give these funds to the common shareholders, but common shareholders are motivated by the opportunity, by the possibility that the company might either pay the excess to them in the form of common dividends, or if the company does retain those earnings, they would expect the value of the firm to increase over time. These three sources, creditors, preferred, and common shareholders, come together in financial markets. Financial markets facilitate the finding of outlets for a saver's unspent income and also facilitate the raising of capital for business enterprises and for government use. The areas of investments, personal finance, financial management, government finance, and the markets and institutions that facilitate these exchanges among them all are interrelated. Ultimately, the wealth that's provided to seekers of funds is provided by households, and those funds are sought by individuals, businesses, and government.